Mortgage rates are rising and fluctuating unpredictably, but are you truly prepared for the hidden fees embedded in your rate lock agreement? As a first-time homebuyer, it's absolutely essential to understand the mortgage rate lock process in detail to avoid potential pitfalls that could derail your financial plans. With current mortgage rates fluctuating between 6, 19% and 7, 5% depending on market conditions, credit scores, and down payments, it's more crucial than ever to comprehend the specific risks of rate lock traps to avoid costly and irreversible mistakes. Let me tell you about Sarah's story, a first-time homebuyer from Austin, Texas who learned this lesson the hard way. She thought she was making a smart financial decision by locking her mortgage rate at 5% for 60 days on her $320,000 purchase. What she didn't realize was that the rate lock came with a 0.75% rate lock fee $2,400, plus an application fee of $500, a processing fee of $400, an origination fee of $1,600, and appraisal fee of $550. By the end of her closing, these fees totaled $6,200, money she wasn't expecting to pay and hadn't fully budgeted for. But here's where it gets worse. Interest rates dropped to 6.31% 2 weeks after her lock. Yet she was unable to renegotiate without paying an additional $1,500 extension fee. Even more frustrating, when underwriting delays pushed her closing date back another 30 days, she needed another extension for $125. In total, Sarah paid an extra $825 in fees and locked-in interest costs, nearly double what she initially anticipated. Unfortunately, Sarah's experience is not unique. According to a comprehensive 2023 Consumer Financial Protection Bureau study, mortgage rate locks can sometimes result in higher interest rates or hidden fees, with the average borrower paying an additional 0.25% in interest over the life of the loan. When you do the math on a $300,000 mortgage over 30 years, this seemingly small 0.25% difference translates to approximately $73,000 in additional interest payments spread across 360 monthly payments. This can result in a significant increase in your monthly mortgage payments, potentially $200 to $300 more per month, fundamentally changing your budget and long-term financial plans. Consider the real-world impact. The difference between the expected interest rate and the actual interest rate could result in a $10,000 to $30,000 gap over the life of a $200,000 mortgage. For $300,000 mortgage, this gap could exceed $50,000. For a $400,000 mortgage in high-cost markets like California or New York, this gap could approach $80,000 to $100,000. According to data from the Mortgage Bankers Association's 2023 market survey, approximately 23% of borrowers who lock rates experienced unexpected fees totaling between $3,000 and $8,000 at closing. Notably, borrowers with credit scores below 680 faced even higher average fees, with some paying upwards of $12,000 in unanticipated costs. To avoid falling into this mortgage rate lock trap, it's vital to understand the complete process, the associated risks, and the often obscured clauses buried deep in your loan estimate, sometimes on pages 3 or 4 of a multi-page document. Let's examine the current mortgage rate landscape in detail. The current 30-year mortgage rate hovers around 8% with a range of 5% to 2% depending on credit score, down payment percentage, and loan type. The 15-year rate is approximately 1%, while ARM adjustable rate mortgage products range from 2% to 8% for the initial period. FHA loans typically range from 3% to 51%, while VA loans for eligible veterans range from 14% to 9%. These rates can dramatically impact your monthly mortgage payments and lifetime cost. For instance, a $200,000 mortgage with a 30-year term at 8% interest would result in a monthly payment of approximately $264 excluding property taxes, insurance, and HOA fees. In contrast, a 15-year term at 1% interest would result in a monthly payment of around $1,821. Over 30 years, the total interest paid at 8% would be $255,280. If you could somehow maintain a 1% rate for the entire 30 years, you'd save approximately $85,000 in total interest. But here's what most lenders don't highlight. In addition to the base interest rates, you must carefully consider closing cost percentages, which typically range from 2-5% of the loan amount. For example, a $200,000 mortgage with a 3% closing cost would result in an additional $6,000 due at closing. A $300,000 mortgage at 4% would require $12,000 at closing. A $500,000 mortgage at 5% would require $17,500 at closing. These costs include origination fees 5-1%, discount points 1-3% of loan amount, appraisal fees $400, $600, title insurance $500, $1,500, title search fees $150, $300, recording fees $50, $200, property survey fees $200, $400, Homeowners insurance $800 $500 annually and processing fees $300 $800. Many borrowers are shocked to discover these add-ons when reviewing their closing disclosure form 3 days before closing, leaving no time for meaningful negotiation or reconsideration. Another critical factor that's frequently overlooked is the loan-to-value ratio and the mandatory requirement for private mortgage insurance, PMI. If your loan-to-value ratio exceeds 80%, meaning you put down less than 20%, you're required to pay PMI. This insurance can add 5% to your annual mortgage payments depending on your credit score and down payment percentage. For $300, 000 mortgage with 10% down, $30, 000, PMI could cost $125, $375 per month. For $500, 000 mortgage with 10% down in a high-risk market, PMI could cost $200, $625 per month. According to Federal Reserve data, PMI persists until you've paid down to 80% LTV through a combination of principal payments and potential home appreciation. On a 30-year mortgage, this could take 10-15 years, though it varies significantly based on your loan amount, down payment, and local real estate appreciation. Some borrowers pay over $45,000 in PMI alone over the life of their loan, essentially paying thousands just to borrow money they'll eventually own anyway. Now let's talk about the rate lock extension trap, perhaps the most insidious hidden fee. Many borrowers lock their rate for 45-60 days, assuming this is sufficient time to close. However, appraisal delays, which occur in approximately 15-20% of transactions according to industry data, title issues affecting 10-15% of transactions, or underwriting complications can extend this timeline. When your lock period expires, lenders offer extensions typically for 0, 125% to 0, 375% of the loan amount. That's $250 $125 per extension on a $200 000 $300 000 loan. Some lenders charge even higher rates, 5% per 15-day extension, which would be $1 000 $500 on a $300 000 loan. One borrower in Denver locked her rate for 45 days at 5% on a $350 000 purchase, but the appraisal came back $25 000 low, requiring renegotiation with the seller. By the time everything was resolved through 2 weeks of back-and-forth negotiations, she needed a 15-day extension costing $875. Then rates dropped to 2%, and she couldn't lock the lower rate without paying another extension fee of $875 plus a new lock-in fee. She ultimately paid $750 in extension fees alone while still being locked at the higher 5% rate. There's also the counter-argument that some borrowers benefit significantly from rate locks, particularly when rates are rising rapidly. During the 2022 Federal Reserve rate hiking cycle, borrowers who locked rates early saved substantial amounts. A borrower who locked at 5% in January 2022 avoided paying 8% by December 2022. However, the key difference is understanding which market environment you're in and whether you're paying transparent fees or hidden fees. The trap occurs when lenders obscure these fees in fine print or fail to explain them clearly during the initial consultation. To avoid the mortgage rate lock trap, you must employ critical protective strategies. First, always request a detailed loan estimate within 3 business days of application. This is legally required. Second, compare fees across at least 3 different lenders. Third, understand the exact rate lock period and extension costs before committing. Fourth, negotiate your closing costs aggressively. Many lenders have built-in padding. Fifth, ask specifically about discount points and whether buying points paying upfront makes financial sense based on your timeline. If you plan to stay in the home for less than 5 years, buying points rarely makes sense. Sixth, request that the lender lock your rate in writing with a clear, itemized list of all associated fees. Ignoring mortgage rate lock traps could result in thousands of dollars in unnecessary interest payments over the life of the loan, potentially enough to impact your retirement timeline by several years. For a borrower retiring at 67 with a mortgage extending to age 77, those extra $73,000 in interest payments could represent years of retirement income spent on housing costs that should have been eliminated decades earlier. Our comprehensive analysis is based on verified data from reputable sources, including the Federal Reserve Economic Data, FRED, the Mortgage Bankers Association 2023 Market Survey, the Consumer Financial Protection Bureau's Consumer Complaint Database, and case studies from major lending institutions. By the end of this video, you'll have a thorough understanding of the mortgage rate lock process, the hidden fees embedded in these agreements, the impact of PMI and closing costs, extension fee traps, and the actionable strategies you can employ to avoid the devastating mortgage rate lock trap.